Fixed income is back in the spotlight. Yields are at multi-decade highs, and investors are rethinking how to position their portfolios in a world where income is abundant, but uncertainty still looms. As the macro environment evolves, so do the strategies for navigating it. So where are the most compelling opportunities in fixed income today, and what risks should investors be watching? Welcome to The Bit, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Pulido. Today, I'm joined by Rick Rieder, Chief Investment Officer of Global Fixed Income at BlackRock. Rick shares his perspective on why income is taking precedence over duration and why systematic strategies are helping investors uncover new sources of return. He also reflects on the Fed's shifting influence and what it means for long-term rates. Rick, thank you so much for joining us on The Bit.
Thanks for having me. This is exciting. I'm pumped to do it.
It is exciting. We're sitting in Huntington Beach, California at the Future Proof Festival, which is a gathering of industry leaders from the wealth management and the investment management industry. You and I are sitting here. I can see palm trees and the beach is just over the horizon. So we have a nice landscape to look at. And perhaps that's the best place to start is the landscape. But this time about the markets and the economy. Few people have their finger on the pulse like you do, Rick. You and your team follow a lot of things around the world. What are the big forces shaping markets right now and throughout the rest of the year?
So, there are a bunch of things going on. I'll hit on a few things. First, economy's in good shape. There is this constant refrain about it's recession, it's coming, get out of the way. The economy's in good shape. I think we can almost hit 5% nominal GDP this year, which is pretty impressive. So, first thing, as an investor, you think about, okay, is the backdrop foundationally in terms of the economy? Pretty good. Is inflation a little bit high? Inflation's a little high. We have a tariff transmission coming in. You've got to respect that. Certainly the Fed will respect that. And then you've got some incredible cross currents that are happening. I talk about dispersion in the economy. The reason why I think the Fed's got to cut rates is low income is having a hard time. You see this in all the retailers that are reporting today. Mid to high income doing fine, low income having a tough time. Housing market is stuck. Fed's got to get that rate down to get velocity of housing moving. So I think rates are going to go lower. I think at the end of the day, the ability to create income in a portfolio is incredible. I lived for 2 decades where you think about, we had negative interest rates. In Europe, we had negative interest rates for 9 years, the craziest strategy of all time. We had negative interest rates. You had to pay to actually hold assets. Today, you can buy European assets because of the currency. You can swap it back and get a lot of yield. Today, you can build a portfolio of 6% yield. That is amazing for fixed income. Most people said, gosh, if you can get me 4 to 5, life is good. What about if I got you 6? Now rates are going to come down. We got to think about how long are we going to get that. But today, I think it's a pretty exciting time in fixed income. And then, in equities, technology change, fast growing companies, privates coming into the equation. So we're like, where do we do privates versus publics? It's the most fun I've ever had investing by a lot. By the way, also you introduce hard assets, gold, Bitcoin. This is the most fun. People, talk. I think people always like to say, the good old times. I don't know. This is a pretty good time.
Sounds like we're living in the good old times, maybe is what you're saying. And you mentioned, oftentimes we do talk about the risks that exist in the market, but right now it sounds like the opportunities outweigh the risks based on some of the things that you're mentioning.
So when people always say, what is the biggest risk that's out there? You usually don't get a heads up on what that is. So today, the biggest risk, I think, is U.S. government has too much debt. We got to keep rolling the debt. We got to keep rolling our long-term debt. We've got to complete auctions of 30-year debt all the time. We got to issue $600 billion almost a week of debt. That is the biggest risk. People generally know it. Usually what you know usually doesn't bite you, but there is a tail risk there. Other than that, one of the things you just got to be thoughtful in a portfolio is complacency. There's an incredible rhythm to the way markets work. It's like every 4 or 5 years, markets have to have a hard time because what happens is you have a hard time, then there's money made, people generate returns, third year is good, and then all of a sudden people say, gosh, you know what, I forget, it was like losing money. And then, we're definitely in the mode now of complacency, and you see it in a bunch of places. So that's something that we always think about. I always think about exit strategy, downside protection. And while we're generating return, you got to think about they're not going to give us the heads up. Here's the thing you didn't think was coming. And that's it's always out there.
You mentioned the Treasury and you mentioned Treasury debt levels and issuance. And so let's talk about that a little bit, because when you do peruse the headlines, you hear things like the debt level in the US, the issuance of Treasury bonds. We have seen long-term interest rates moving higher. So talk a little bit more about why does that matter? Why is that important to keep an eye on?
So there are a couple of things. First of all, I hear, I woke up the other morning, I was listening to TV, and people were screaming about rates are unanchored, they're unanchored, like this is. So if you take this year, returns in fixed income, depending on where, global fixed income is over 7% positive. U.S. fixed income, depending on what, our funds are up almost 7 in a bunch of places, 6 for the index. I don't know. It's not like, when people say it's unanchored, like we're far from unanchored. But I've learned before, the markets can stop. We used to fund our debt internationally. So you think about Chinese would buy our debt, Japan would buy our debt. They now have their own domestic that they need to fund. So one of the things we have to rely on is domestically, we have to keep buying our debt. And then hopefully U.S. economy outgrows it. And I think that's one of the big things we're going to watch for the next couple of years. Can we grow fast enough? There's only one secret to how do you outgrow the debt, or how do you reduce a debt burden? You have to grow faster than the cost. So if we can get the interest rate down at 3%, if the Fed gets that rate down and we can grow at 5 nominal GDP, we'll be okay. And so the markets are still going to be on edge about it, and everybody will be on edge for fear that it doesn't happen. But for now, the base case is we're going to make it through.
Let's focus in on fixed income. You're obviously the CIO of global fixed income for BlackRock, so it's a space that you follow very closely. The fixed income markets are very broad across the world, and they encompass a lot of subsectors. So you touched on the fact that interest rates are now at highs compared to the last 2 decades, and we're out of this environment of negative interest rates. So when you zoom in on the fixed income markets, maybe be a little bit more specific. Where are the opportunities that get you excited?
So for a long time, by the way, it's very different than the equity market. If you said, is that, we do also run some equity funds. If you said today, where do you like equities? I do like the US better than, I think Europe's slower growing. It's an ironic thing today. I've been buying more European fixed income I've ever bought in my career because people are hedging the currency. And as a dollar investor, you get the benefit of that. So we get an extra 2.5% of a currency. So for years, 2014 and 2022, you had negative interest rates, what we talk about in Europe. Now we're getting to buy European fixed income, 5.5 to high yield at 8%. That is spectacular because Europe grows just slow enough to not worry you as a debt investor. So that's a beautiful thing. Emerging markets are starting to enter the equation, softer dollar. The yields are terrific, not without volatility, but I think that's exciting. And then, the rest of it is, so we're selling down some of the investment grade debt because spreads have really tightened. But high yield today still gets a 7%-ish, depending on where you go. At the end of the day, people get worked up and there's a crazy set of stats. I talk about, like, if you look at tennis, the best tennis players in the world, the number one rated players win 54% of the points. So what they do is you got to win the big points. You just got to stay in the game. And that in high yield today, just stay in the game. And if it was, we can just keep clipping 7. And I think that's what fixed income is about today. Try not to hit a home run. Equities are good for a home run. You do some crypto, some other things for a home run. Let's just get 7. And by the way, we're annualizing considerably better than that today. If rates come down, you could get high single digits, maybe even a little higher than that. So anyway, that to me, that is clip the coupon and life is good.
And you mentioned that depending on the asset class we're talking about, if we're talking about equities, you favor the US a bit more. But if you look at fixed income markets, you might look to regions like Europe a little bit more. Rick, you've talked for a while about the benefits of an unconstrained approach to portfolios and being dynamic in this kind of environment. So when you then think about the asset allocation in a portfolio, you've touched on a lot of different themes, but maybe go a little bit deeper there as well. Like, how would you think about asset allocation in a portfolio?
Listen, one of the great gifts I have to investing, and that's been a huge benefit to us, is the ability to move around. The regime changes. It's like, would you buy a clock that doesn't work? It'll be right once. Today, think about, you could be in the front to belly of the yield curve. It's been a home run. Stay there. You don't need to own the long end of the curve. There's a lot of parts of an index that are negatively convex, they're negative return potentials, high coupon mortgages. Today, being able to buy Europe, being able to, at times use some of my unconstrained to do bespoke, private-oriented financing. Even if a 10%, 12% position, you get an extra 20 basis points on the portfolio. Move around and do that. In things like residential real estate, part of the commercial real estate that everybody writes it off, but there's some really good financing because people have written it off. So that ability to move around parts of the yield curve, parts of the globe, in you can buy high quality in Europe, high quality companies in subordinated form, get a bit more yield. They're not going to default. Like it is a gift to be able to, I call it, make a little bit of money a lot of times. You don't have to take a huge rate swing. Just keep doing it. I call, make the sausage every day. Just literally every day, find a cheap asset, go around the world and do it, and then get the big regime characteristics right.
And you talked about European bonds. I think what you said was you can invest in Europe, and if you hedge your currency exposure back to US dollars, if you're a US dollar investor, now you can actually get a pickup in yield, and an area that looks interesting at the beginning becomes even more interesting. Are there other opportunities like that? I'm just curious, as you look around the globe, what other regions and what other opportunities like that pique your interest?
So, one thing I've learned in my career, like if you just invest for carry or for the highest yield, there's a good chance, like usually when you're chasing the highest yield, it's dangerous. So we got to be thoughtful about it. So for example, places like Japan, long end interest rates in Japan, you get that same currency benefit, but you can lose money pretty quickly. So I've tried to be hesitant. We've been hesitant around taking exposure there. Parts of emerging markets now, if the dollar stays low or softer, these yields, and by the way, a number of the emerging market countries have to cut rates, slower economy, et cetera. So we've been doing some of that. But that currency, think about for a decade, 2 decades, it was international investors coming to the US to buy fixed income. Today, a lot of international investors saying, gosh, I'm worried the dollar goes down. They're hedging it. So as a dollar investor, it's something we haven't been able to benefit from for a long time at this scale.
And I think you've actually talked about this, that you mentioned the dollar. The dollar hasn't been the safe haven in periods of risk off that it has been in the past. Like maybe talk a little bit about your currency view there, because in the past, the dollar is usually where people flock to in periods of volatility. But we've actually seen the opposite in the few periods of time this year when we've seen market vol.
Totally. So first thing I will say is currencies are the hardest way to make money. Everybody's an expert on the dollar, and 99.9% of people don't get it right on positioning. It's very, very hard. There are a few things today that suggest that currency could soften from here. We talked about the debt burden in the country. We talked about international investors diversifying into things like gold that are buying less in the US. We talked about Fed, if they cut rates, that could pressure the currency a bit lower. So, when you add up the debits and the credits today, it certainly feels like we're going to go to a softer currency. I think it'll be contained because there's so much money that will M&A opportunities, equity opportunities in the U.S. So, but I think the broad framework is probably a weaker currency, and then what do I do to protect against that? Hard assets. I was just asked on television about how much would you have in Bitcoin? Would you have 5%? Some of these things seem pretty sizable to me. Like I still think the dollar will be okay, albeit weaker. And by the way, buying equities, where the return on equity is like 23, 24%, you outrun a lot of currency softness, particularly even if you're an international investor. So listen, I'd managed part of your portfolio to a softer currency, but I wouldn't overdo it.
And Rick, I mentioned at the beginning that few people have their finger on the pulse on as many markets as you do. But what would be the one takeaway if somebody's listening to this and hearing a more optimistic tone from you, whether it's opportunities in equities or the abundance of income in the fixed income markets, but what would be that one takeaway you'd want an investor to have?
So can I throw out a crazy statistic? So I looked at this the other day. So I talked about in tennis, the top player wins 54% of the time. And then I looked at the equity market since March of 2009. The equity market's up 1,200%. It's up 54.7% of the days. And it's up 1,200%. And then I actually looked at, if you strip out when the Fed, on Fed days and the day before, it actually would be up about half less than that. Okay, so what do you do with all that? The numbers are crazy. They're crazy when you actually think about it. What it tells you is you got to stay in the game. Like you got to, everybody, like this piece of news, what do we do with that? How do we think about that? This is a crisis. You got to stay in the game. And, one of the things I found for investing my whole career is when price is more important oftentimes in the news, because what happens now with social media is the markets instantaneously move and by the way, overshoot. And so what I found is, like, even if you didn't see the news, If the market went down and the market went up, probably time to do the other thing to create. But at the end of the day, with a ballast of your portfolio, with the foundation portfolio, you got to just stay in the game, particularly in fixed income now when you get this income. Like, just sit back and enjoy it. And my guess is a year or two from now, people are going to look back and say, wow, those yields were pretty good. And so I think today, you just got to stay in the game.
Well, Rick, thanks for being a good sport here today on The Bid. As you can see, we've had a lot of distractions. We've had people walking by, we've had cars driving by, and we even had, I think at one point, a helicopter flying overhead. But to some extent, it makes sense because as an investor, you're dealing with distractions every day and having to focus on the long term. So a lot of parallels there.
And every day, I say this, what actually separates, I always, think I got to be a better investor and try and be a good investor. The best investors I've ever seen have the ability to separate the news from the noise. What is news? What's important? What's noise? Today, we've had a pretty good reflection of that. Just ignore what's going on externally.
Absolutely. We want to thank you, Rick, for joining us here. Thanks for joining us on The Bid, and we hope to have you back at some point.
Thank you. Appreciate it.
Thanks for listening to this episode of The Bid. Next week, join me as we examine what equity opportunities exist in the infrastructure landscape. Subscribe to The Bid wherever you get your podcasts.